Is preferred equity just smarter equity, or is it leverage in disguise? I'm Jessewelch, and I'm not in the Epstein files. This is capital letters. If you're a commercial banker who wants to think like an investment banker, or if you're already an investment banker, or maybe you're just looking to raise capital, maybe you're a sponsor trying to understand what you're actually signing, today is the day for you. Today we're going deep because pref equity or preferred equity, it gets marketed as flexible capital, non-dilutive, aligned. I love that word, sponsor friendly. And sometimes it is. Sometimes it actually is very sponsor friendly. But sometimes it's just expensive risk that doesn't look like debt until suddenly it starts behaving like debt. In this episode, we're going to break down what pref equity actually is. We're going to break down where it sits in the capital stack and why sponsors use it, and also what it means to investors, not just the pref investors themselves, but the common investors, the common equity investors who sit alongside the sponsor, and also how it behaves in a downside and how it gets underwritten from the perspective of an IC member, not like a pitch deck. Because if you don't understand pref equity, you don't understand the deal. Let's start with what it actually is. What is pref equity? Pref equity is not debt. It's also not common equity. And if you think it's just equity with a coupon, you're already underwriting it wrong. So let's just define this thing as precisely and cleanly as we can. Preferred equity is a capital layer that sits above common equity and below all the debt in the capital stack. It receives a preferred return, sometimes floating, sometimes fixed, priority over common in distributions. Often it has structural protections, but usually no foreclosure rights like a lender has. So it's equity legally, but economically, it often behaves like structured yield capital. So a typical capital stack, like a very simplified capital stack, you've got your senior secured debt, you got your mezzanine debt, you got your preferred equity, and then you have your common equity. So it's right here, right? It's junior to all the debt. However, it gets paid before common. In a cash flowing deal, distributions, they waterfall kind of like this, usually like this. There's the debt service, there's the preferred return, there's the catch-up or the participation sometimes, and then there's residual to the common, right? The residuals go to common. It's a negotiated instrument. There's no standard form, and that's where the underwriting really begins. And really pay attention to this, because the type of people that are going to invest pref equity, especially professional pref shops, they are guys who know how to underwrite and who have balls. They understand risk and they go for it. What it is not a loan, right? There's no maturity default in most structures. It is not a passive LP position, and it is not a free extension of leverage. It is capital that trades control for priority. Debt has remedies. Common has upside. Pref, it sits in between, right? And it's that gray zone where risk hides. The reason that it exists, so sponsors use pref equity when they've maxed out their senior leverage and when mezz is too restrictive. They don't want to dilute common control. They still want to, but they want to smooth IRR math, right? Or they need gap capital to close. Pref is often the bridge between what the banks will lend and what the sponsor needs to make the deal pencil, right? Mezz can be very expensive. Mezz can be very restrictive. Pref, because of its semi-flexibility, can solve a few problems. The core tension is that pref equity investors, they want predictable yield and downside protection, right? So that's what these guys want. Sponsors, they tend to want non-dilutive capital, right? That doesn't act like a lender, which it doesn't really happen. These two desires are just not naturally aligned. Square peg in a round hole kind of problem. That tension drives every pref term sheet. If you are underwriting pref equity, you're asking, what happens if this deal performs? What happens if this deal stalls? What happens if this deal breaks? Because pref equity is boring in the upside. However, it becomes very, very interesting in the downside. So let's talk a little bit about the mechanics of how pref works. Not necessarily like the intercreditor agreements or how it works downturn, but the actual return structure and how pref investors really get paid. So let's get into the part that most people completely misunderstand, how pref equity actually gets paid. If you don't understand the waterfall, you don't understand pref equity. And if you don't understand the preferred equity return structure, you're underwriting fiction. The preferred return, most preferred equity deals, they start with a stated return. An example would be something like 10% fixed, SOFR plus 600 or a 6 handle, 12% compounding, 8% return plus 4% PIK. That is not interest. That is a preferred distribution right, meaning if cash is available, the pref gets paid first before common receives anything. If cash is not available, it usually accrues, and that accrual matters a lot. Some pref investors actually preferred accrual over cash back because it means in the end, if the deal performs, they make more money. Current pay versus PIK. Let's look at these two core structures. Current pay are cash distributions. They're made periodically, like quarterly, monthly, annually. A PIK stands for paid in kind. That's a return that accrues to principal and compounds. PIK matters because it makes sponsor life easier in the short term, but it increases pref's claim in a downturn. Compounding return is how small problems become large structural issues. The waterfall, let's give a clean example of the waterfall. You got your senior debt service, right? You got the preferred return paid, right? Current or accrued. You got the return of pref capital, the catch up sometimes, and then the residual split to the common, right? Some pref structures include participation, like 20% of the upside, generally after a hurdle. There's IRR step-ups, exit fees, redemption premiums. This is where pref shifts from yield capital to structured equity. And if you hear somebody saying we invest equity into a deal, but we always invest it structured, this is what they're talking about. They're talking about pref, and the structure matters a lot. Let's say you have a $100 million deal and you've got $60 million in senior, you got $10 million in pref, you got $30 million common, right? You're doing okay. You got all your money. If the deal exits at $105 million, debt gets paid, pref gets paid, common might get almost nothing. Actually, they might get nothing in that scenario. Pref doesn't need a home run, common does. And that asymmetry there is what defines the economics. Sponsors sometimes say it's only 10% pref. That is very misleading, quite frankly. If the pref compounds and sits for 5 years, that's not 10%. That's probably going to look more like mid-teens effective return. So always, 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 sponsors and investors, calculate accrual mechanics. Calculate compounding frequency. Calculate exit assumptions. Downside breakpoints especially, because pref math looks simple until you model it, and especially until you model it in a cap stack. When you're underwriting pref, you're asking a couple things. You're asking, well, one primary thing you're asking is the return sufficient for the risk? Because remember, pref is junior to debt, and in stress scenarios, debt controls the steering wheel. It is possible that pref investors can invest and go to zero. I mean, anybody can go to zero, but theoretically, pref is a little closer to that risk point, right? Let's talk a little bit about control now, because the real story in preferred equity is not really the coupon, it's the rights. We're going to get to the part here that actually decides outcomes in bad deals. Pref equity feels passive until the model breaks. Then it's about documents, not distributions. Let's kill a myth right now. Pref investors do not just collect a yield. If structured properly, pref equity is built around control rights that activate under stress. Because remember, pref sits behind senior debt. I mean, like everybody sits behind senior debt, but pref sits behind all the debt, even the mezz. If performance deteriorates, debt has leverage first, and usually most control. So pref documents are designed to protect the position before that moment arrives. Negative covenants. I've talked about these before in debt. These restrict sponsor behavior. Pref loves these, needs these. Common examples are going to be like no additional debt without pref consent. Sometimes you'll even see that in mezz. No sale or refinance without pref approval because they want to get paid. No change in the business plan. They don't want you shooting at a new target. No affiliate transactions. No distributions to common until pref is current. That is like always a covenant. These are preventative controls. They don't want to give you the steering wheel. They stop reckless driving. And ideally, they stop it before it becomes a problem for debt. Because once debt sees a problem, no bueno. To underwrite correctly, you need to be looking at monthly financials, budget versus actual, access to management, annual audited statements, or sometimes more frequently than annual, because capital without visibility is gambling, and visibility is how pref decides when to escalate, and pref investors are not gamblers. Protective provisions. These are important. This is where things get real. If pref is not paid current or if covenants are breached, pref can receive board observation rights if they don't already have them, board seats if they don't already have them, blocking rights in major decisions, even in minor decisions sometimes, and springing control rights. This is why pref cannot be evaluated only on the coupon. It is a hybrid between equity and mezzanine discipline. Equity with debt-like features is one of my favorite phrases because that's how it acts. Remedies and default. This is like the structural heart of the investment, right? Depending on the deal, pref might have redemption rights. They might have forced sale triggers. They might have the right to convert into controlling equity. They might have the right to force you to refi, step-in rights, voting control upon payment default. And they're coming in at the equity level, so they're coming in at the holdco level. Here's the nuance, though. Pref does not typically have foreclosure rights like mezzanine debt. It cannot seize collateral directly. This is a critical distinction. Pref enforces through equity mechanics, not UCC remedies. And why this matters in a downturn is because senior debt restructures first, right? If leverage is too high, equity can get wiped. Pref is equity. Pref sits in between the common and the debt. So if enterprise value drops below the debt plus the pref is going to take that hit. Pref is going to be impaired. If enterprise values stay above pref but below common, pref might take control, right? Because they still have a chance to get their money out. So underwriting pref requires asking, where does enterprise value break? And how fast could we get there? From an IC perspective, when evaluating pref, you're not underwriting, will I get 12%? Because you should be getting more. What you are underwriting is, if this company underperforms, do I have the contractual leverage to protect principal? Because pref wins when the deal performs moderately, when downside is limited, when documents are tight. Always you got to have tight documents. It's so important. But pref loses when leverage is too high. Everybody loses when leverage is too high. Except the senior. Like I said, senior debt never loses. Pref loses when covenants are weak, when enterprise value erodes quickly. So let's talk about valuation risk and where pref actually sits in the capital stack. Because if you don't understand subordination, you're underwriting blind. So we're going to get to the structural core, sometimes way down there. Pref sits above common, below all the debt. That positioning defines everything about its risk profile. So senior debt gets paid first, always. Mezz gets paid second. Pref only gets paid after debt service is satisfied. Common equity gets paid last, if they get paid at all. If enterprise value declines, losses move upward. Common gets wiped out first, then pref, then mezz, then senior. It's like the opposite. From the who gets paid, right? Who loses, inverse of each other. Pref is not protected by collateral like debt is. It's protected by structure, by pricing, and by control rights. Very different form of protection. And that's why it's a very different type of underwriting, and it's usually a very different type of lender, or not lender, investor that's putting money in through Pref. The real risk question when you're underwriting preferred equity, you're not asking, will this company grow? You're asking, at what enterprise value does my capital get impaired? An example might be enterprise value of $200 million. You got senior debt of $100 million. You got mezz of $20 million, pref of $30 million, and common of $50 million. If the value drops to $150 million, your senior, they stay whole. Mezz stays whole. Pref stays whole. Hell yeah. Common gets partially impaired. Probably fully wiped out in that scenario. Now, if the value drops to $130 million, holy crap, that hurts. Senior stays whole. Mezz stays whole. Pref gets impaired. Common gets wiped. Like, they're gone. That $130 million break point is the real underwriting threshold, right? That's the level that matters. The reason sponsors use Pref is because Pref increases leverage without tripping debt covenants, right? Debt markets, they might cap leverage at like 5.5x EBITDA. That's pretty normal. Depends on the industry. But Pref allows a sponsor to close valuation gaps. They can fund acquisitions. They can recapitalize. They can return capital. They have a bridge to their exit without increasing senior leverage ratios. See that? That's one of the primary tools that Pref is going to be used for. It's leverage disguised as equity. That's why lenders tolerate it. But that's also why Pref underwriting must be very disciplined, because your threshold for risk must be higher, because you have a higher chance of losing everything. So let's think how it compares to mezz, right? Mezz debt has contractual interest, has maturity, has UCC remedies, and can foreclose. Pref has distributions but not interest, often perpetual or tied to the exit, enforces through governance, not foreclosure, and relies on enterprise value stability, right? So mezz is going to enforce through legal rights on assets. Pref is going to enforce through leverage over equity. That distinction matters a lot in distress. All of these distinctions matter a lot in distress. They matter the most in distress, quite frankly. If nothing's in distress, you just need to be not tripping your covenants and paying your interest rate. So return profile versus risk for Pref. Typical middle market Pref might be 8 to 14% coupon, cash or PIK. Might be 1 to 2% MOIC target. IRR in the low to mid-teens, probably mid-teens these days. It prices between debt and equity, right? Lower risk than common, higher risk than mezz, if structured correctly. That's not always the case necessarily. Loose documents turn Pref into junior equity with a coupon illusion real quick. Tight documents make it a very disciplined capital instrument, and that's really what you want. So what I see should be asking is, when evaluating Pref, what is the value cushion below debt? What is our impairment threshold? How realistic are these projections? And are covenants strong enough to intervene early? Because Pref needs to intervene early, needs to intervene before any debt, right? And also, is exit timing within control? Because Pref lives and dies on downside protection, not fantasy upside, right? So let's talk about what Pref means for sponsors strategically, why they use it, when they should, and when it's a mistake, because it's a fantastic tool. So we'll shift perspective a little. Preferred equity is what you use when you want more leverage, but can't admit that you're adding more leverage, right? Let's be honest. Sponsors use preferred equity for one of 4 reasons. 1, they need to bridge a valuation gap. 2, they want to de-risk their own position, their own equity. 3, they want to return capital early. Or 4, they can't raise more debt, more senior or mezz without breaking covenants. Pref is usually a solution to that constraint. So let's look at a scenario. Bridging value gap, right? Seller wants 10x EBITDA. Senior and mezz support 7.5x. You can walk away. You can write more common equity, or you can layer in Pref. Pref lets you fill that 2 to 3x gap without diluting sponsor ownership as much as Common would. Common would dilute it fully, right? However, there's a trade-off, as there always is in life. You've now introduced a fixed cost layer above you. If performance lags, that Pref accrues. And the deeper you dig, accrued Pref compounds. Sponsors forget that part. Pref investors don't. Scenario 2, dividend recap, right? Company performs well. Senior lenders allow a dividend recap. Instead of over-levering senior, the sponsor can bring in Pref. Why? Because Pref doesn't increase senior leverage ratios, right? May not count as debt for covenant purposes. It doesn't destroy or doesn't trigger rating pressure. And sponsors, sponsors want to return capital while maintaining optics, right? You think of it like financial engineering, not operational improvement. It works. It works well until it doesn't, like most engineered things. Scenario 3 is growth capital without losing control. Sometimes a sponsor wants capital for expansion, but they don't want to sell additional common. They don't want to dilute ownership. They don't want to reset valuation. Pref gives capital with no voting dilution if structured properly, or correctly, I should say. Sometimes Pref is only voting and not economically participating. But Pref investors will demand protective provisions. So while control isn't diluted economically, it can be constrained legally. And there's also like hidden sponsor risk. Pref is senior to common in exit waterfalls. So let's say the multiple compresses, right? The exit multiple. And enterprise value is flat, debt gets repaid, Pref takes its 1.5x. Common might get far less than projected. Sponsors sometimes underestimate how much Pref reshapes the exit math. It's going to reshape the exit math a lot. Pref is expensive if growth underperforms. It's very cheap if growth outperforms. It's like a directional bet based on execution. Sponsors should avoid Pref at all costs if cash flow is volatile. If exit timing is uncertain, if industry multiples are compressing, because if industry multiples are compressing, your multiples are going to compress potentially more. And if the capital is being used to patch operational weaknesses. Pref is gasoline on a slow leak. It can buy you time, but it won't fix your fundamentals. Good sponsors use Pref for like clean, definable value creation, short duration bridges, strategic flexibility, tactical balance sheet optimization, not for hope. Equity can be used to fix cash flow issues. Pref equity is not a very good tool to fix cash flow. It's not for ego-driven valuations. It's not for paper IRR smoothing. What does Pref equity mean to the investor providing it? Well, investor calculus is entirely different. So let's talk about that a little bit. If you're underwriting preferred equity, you're betting you get paid first, but not paid last. Pref investors live in a very specific psychological space. They don't want equity volatility. They don't want senior downside exposure. They want structured upside with priority. It's a hybrid risk profile. Like I said earlier, the guys and gals writing Pref equity, they got balls. They deal with risk. From a risk spectrum, from safest to riskiest, senior debt, safest, mezzanine, a little more risky, Pref equity, more risky, common equity, most risky. Junior to debt, senior to common means two things. One, you are exposed to enterprise value risk. And two, you still have structural priority. So you're not just writing cash flow coverage alone, which is what equity might write. Debt might write. You're underwriting exit value. Different mindset. That's the equity mindset. Pref investors, when they're underwriting these deals, they should be asking, what is the enterprise value today? What's the debt stack, senior plus mezz, plus sometimes there's even like a third stack in there. And where does my capital sit in liquidation? How much downside before I'm repaired? So if senior is like 4x EBITDA and mezz is 2x EBITDA, your total leverage is 6x. Pref at 7 or 8x is taking valuation risk. If multiples compress from 10x to 8x, Pref might still be fine. If they compress to 6x, Pref could get clipped. So underwriting pref is a big part of it is underwriting cushion. The things that pref investors are really going to care about: exit timing, IRR math, accrual compounding, sponsor quality, always sponsor quality. Unlike senior lenders, sponsors care very deeply about who the sponsor is because pref returns often depend on refinancing, recapitalization, or a sale event, and those are all in the sponsor's domain. If the sponsor is undisciplined, pref becomes trapped, and nobody likes trapped capital, except for maybe sponsors. Now, investors like pref because it offers like 12 to 20% target IRRs. You get some structural priority, yeah. You get equity-like upside with a little bit of buffer. It can outperform mezz, actually, and it often does if it's structured well. And it can avoid the volatility of common. So in an environment where senior yields are compressed, public equities are volatile, LPs, they want yield. Anybody investing wants yield. Now pref is starting to look pretty sexy. So pref blows up, however, when growth stalls. When, like I said, exit multiples compress because pref is looking for that exit. Refinance, sale, whatever it is. When senior lenders tighten covenants, that's not good for pref. Or when sponsors refuse to sell. Pref accrues, IRR targets evaporate, and suddenly safe equity is not safe. It's stuck. Pref is not riskless. It's valuation sensitive capital. The real game in pref is you're not betting on survival. You're betting on disciplined execution and a timely liquidity event. That's why pref investors, they spend as much time evaluating sponsor track record as financial projections, because capital stack math is very simple. Human behavior is not simple at all. Except you can say that humans are predictably unpredictable. So let's tie pref equity back with the capital stack and explain when it should exist and when it shouldn't. If you're using pref equity to fix a bad deal, you're already in trouble. And you might be a bad sponsor too. Let's bring this back to the cap stack. Pref equity is not a magic layer. It is a pressure valve. I think I probably said that about mezz too. Mezz is really a pressure valve. But it exists for one primary reason. That is to bridge the gap between what senior lenders will give you and what sponsors will dilute. That's it, basically, in a nutshell. When pref equity makes sense is when the business is stable, when the sponsor's credible, when there's a clear path to liquidity, when senior lenders are maxed out on rational leverage, when common would be too dilutive, right? In that situation, pref is elegant. If you can't get any more senior, hell yeah, you want some pref. If you can get more senior, why are you selling pref, right? It preserves sponsor ownership. It gives investors priority. It enhances returns without immediately destabilizing the capital stack. If you use it correctly, it is surgical. And a good pref investor, a pref lender, there's a couple of them in real estate. There's this group called M2, fantastic groups of people to work with. Here's the uncomfortable part, however. Pref can be dangerous. It's dangerous when it's used to prop up weak cash flow. If it's covering like an overpay or an entry multiple, if it's stacking on top of already aggressive leverage, if there's no defined exit path, or if the sponsor is hoping for multiple expansion, pref can't fix bad underwriting. It can only amplify it. It can also amplify good underwriting. It's valuation sensitive capital. If enterprise value doesn't grow, or if multiples compress, pref becomes trapped, and then it becomes a negotiation. And when you're a sponsor, you never want to negotiate a second time, especially if you're an investor, actually. Negotiations at the bottom of a stressed capital stack are not fun and not friendly. So let's be clear. Senior debt cares about cash flow protection and asset value. Mezz cares about blended yield and structural protections. Pref cares about exit math. Common equity, they care about upside, right? Because they get everything left over. Could be 50x. Every layer prices risk differently. If you don't understand how every layer thinks, you will structure your deal wrong. You structure your deal wrong and the capital stack will spank you. You will be disciplined. That is why capital stacks exist. It's like mommy, daddy, grandpa, grandma, right? Pref equity is not cheap. It's not safe. It's not almost debt. It is a strategic instrument. It belongs in disciplined deals only with credible sponsors and clear liquidity pathways. It does not belong in desperation. If you are stacking pref just to close, you might be manufacturing tomorrow's restructuring. So that's pref equity. Clean, precise. Hopefully you guys understood what exactly it is. Capital stack reality, my favorite thing. I'm Jessewelch. Thank you guys for watching. This is Capital Letters. If you want to think like an investment committee instead of a borrower, subscribe to our newsletter at Capital Letters. You can also go to www.midcapglobal.com if you have a project or if you have a mandate that you need to satisfy. Come say hi. Follow us on all the socials. We're on YouTube. We're on TikTok, probably on Instagram. Like I said, we have a newsletter, and here we are on YouTube. Please like and subscribe. That helps us more than you can imagine. Until next time, go close something.